Hey everybody, welcome to Mountain Seeds webinar. I'm going to give everyone a couple more minutes to filter in and we're going to start the call in about a minute or two. Thanks.
Hey everybody, this is Nathan. I'm the president here at Mountain Seed. Thank you for joining us today on our webinar series. We're excited to have Derek from ORMS on the call. Derek's the president of ORMS. ORMS is dedicated to helping financial and real estate firms manage their environmental risk. Prior to ORMS, Derek was a civil and environmental engineer. He has an MBA from the University of Connecticut. He was a former managing director at EDR, a name that most people on the call are familiar with. He's authored several articles on environmental due diligence and other property risk topics. And I could probably go on, but we're excited to have Derek here today to talk about environmental due diligence. And without any further ado, Derek, I think we'll just turn it over to you, and then we'll be back at the end to figure out who has questions.
All right, Nathan, you can hear me there?
Yep, we got you.
Okay, great. All right. Well, hey, thank you very much, and I'm really happy to be here this morning or this afternoon, depending where you are. As many of you know, the environmental process within the lending process can be rather challenging, and there's a lot of issues. We have a lot of similarities between environmental and appraisals, and that they are, and we'll talk a little bit more about that as we go through the presentation. I want to thank you all for joining. Also want to thank Mountain Seed for having me on the call, and hopefully for some of you it may be a refresher. Some of it may be things you hear for the first time, or really just maybe a couple things in between. But as you probably know, within the lending side of the business, environmental issues can be confusing, can be really just a pain to do. And one of the things you'll see about this presentation, and I want to make it clear, it's not a highly technical presentation. It's more of it's meant to kind of be an overview of the things that you want to be considering when you're doing environmental policy and procedures, and also how you execute that within a bank or credit union. And it's funny because a lot of our customers that we work with, we end up hearing this phrase, I know enough about environmental to be dangerous. And that tends to be a common theme within the industry, in that there's a lot of interaction with the environmental process, but it's not necessarily something you do every day. So hopefully we will shed some light on that. So part of what we've ORMS does do work with lots of banks and credit unions throughout the country, similar to what Mountain Seed would do on the appraisal side for the environmental process. And we did an informal poll to our customers and to banks and credit unions, and basically said our environmental issues typically not looked at because of ignorance or apathy. And the result was we don't know and we don't care. You'll see within this presentation, we're going to try to keep it light. I've been doing this is my 25th year doing environmental work. what we've come to realize is if you don't have a sense of humor in this industry, you're probably going to have a tough time dealing with it. So you'll see there'll be some slides here to kind of keep everyone on their toes a little bit, as well as just to kind of keep it light here. But we will have some really good information for you as well. So, one of the things is being in the environmental industry is you realize, especially on the lending part, is it's usually the last thing done before a loan gets done for a commercial real estate property. So everything else gets done. The credit goes through, everything goes through. Even the appraisal usually gets done prior to the environmental being ordered. And ironically, the environmental tends to get ordered, and then they also put a closing date at the same time when the environmental is due. So I just thought the slide was kind of funny in that that's sometimes how it feels being in this industry, is that you're sort of the last thing there. Only because it has to be done, not because everyone loves doing it. So it's kind of along that theme with how environmental is within the lending institutions. So this is usually, if you're working at a bank and you're on the credit side, this is what your borrowers or loan officers are looking like when you tell them you need to do environmental, and which is the first step. And God forbid you actually find out that there's problems. This is potentially the reaction you get from them. And then in general, the whole process can just feel really difficult. And I would say that, doing this for many years, I worked within a bank at Fleet Bank, 15, 20 years ago now, doing this process. And it is challenging because a lot of times people are trying to just manage through it and not really necessarily being experts. And depending on how big of a bank you're at or a credit union, it can have different levels. So with that kind of as a backdrop, I just wanted to kind of go through some different components of what's happening in the industry. And even though it's an environmental presentation, I think understanding what's going on in the commercial real estate industry in general is important. So things that we're seeing and that we've been seeing, especially since it's 10 years later now, but since the crash back in the late 2000s, regulators are definitely noticing more of what's being done by banks and by credit unions now. The credit unions actually have the new rule that came out a little over a year ago now about commercial real estate or about business lending in general. Phase ones had a new standard. We'll talk a little bit about phase ones in a little bit, but not in too much detail. SBA lending has been on the up and up for many, many years now. Each year, it seems like the SBA lending world is getting bigger and bigger. They're doing more commercial real estate within SBA, and we'll talk about within this presentation how the SBA has its own rules, which I will say I really like because I think it's helpful for the whole industry. In general, commercial lending has become more popular. Commercial real estate tends to be a safer place to lend money, so everyone's fighting for commercial real estate, and I think we're at that point again where there's probably more interest in lending than there is in actual properties out there. And then one of the things which will be the theme of this talk is the environmental and appraisal policies that are being updated, and they're being updated to not only to make sure that banks and credit unions are taking care of risk, but they also need to be competitive with the industry. And I think it's important to balance that. And that's one of the things we'll talk about today is you want to make sure you're protecting the bank. And I'm just going to say bank for lack of a better term. I know there's a lot of credit unions on the call, and credit unions don't mind hearing bank. Banks don't like hearing credit unions sometimes on that conversation, but I understand. I'll just use bank for this call. But the levels of due diligence, there's more levels than ever. And I'll explain a little bit about the similarities between environmental and appraisals, and it's actually becoming more and more similar in that there's different levels of due diligence. So just to kind of give an example, this is credit unions and how much business lending they've done and how it's increased over the last 10 years or even more since this time. But I did a presentation to the NCUA a year ago or so, and because of their business loans going up. So obviously within this, commercial real estate's also increased. So it's important that credit unions are starting to understand due diligence better than they may have in the past. And then in general, I just show these charts more for relative purposes, more so than anything. You're looking at this. This is May of 2009 is when commercial real estate was at pretty much its low, and then now, as you can see, December of this past year, the numbers are actually higher than they were in September of 2007 for pricing. So we definitely made a recovery. There's a lot of commercial real estate loans being done out there. Therefore, there needs to be policies and procedures in place to manage the environmental along with everything else that goes along with it. And this is just yet again another just more to see the shape of this curve, that there's a lot of renewals that are still coming due for the next 3 or 4 years of maturities of loans that were out there. So it was intended with CMBS being the main component, but you're seeing a lot of banks have a lot of maturities coming through from 5 and 10 year notes that they may have had out there. This all just speaks to the fact that there's a lot of real estate that's being financed, so that the need for an environmental policy is as critical as ever right now. So one of the things I do like to talk about, and especially on this call, it makes a lot of sense, is that people seem to be more familiar with the appraisal rules, mainly because the rules are a lot more specific than they are for environmental. But once again, a little bit of a tongue-in-cheek comment, but it's a little truer than I wish at times, is that the environmental and appraisal process tend to create a hate feeling at times within the lending institutions because of the process. Not necessarily the people, but just the fact that it has to be done. If the environmental doesn't come back clean or the appraisal doesn't come back with the value you want, it can mess up a deal. So people get very up in arms about that. It does get done at the end of the loan once all the quote unquote important things are done. So it does get left at the end because most of the time lenders don't want to force their clients to spend money if they don't have to. It's outside the deal, meaning it's not necessarily a core competency for a lot of the people involved. There is a checkbox mentality to the program where people are just trying to make sure they get it done so they can do the loan and not get in trouble. But they're both very critical for collateral valuation. And obviously the appraisal is specifically for the collateral valuation, but the environmental can play a big role as well to make sure that you're not lending money on a property that is not valued what you think it is because of an environmental concern. And then clients of the people who buy appraisals and environmental, the concerns they have are the turnaround times. I don't think they're that long, but if it's being jammed in at the end of a deal, it can be a problem. The costs are always a concern from a competitive perspective. There's a lot of misunderstandings regarding scopes of work for both. There are compliance issues. The value conclusions obviously are a big part of the appraisals. The work product, the qualified appraisers or environmental folks, concise. People want shorter reports. They want things to tell them what they need to know, not necessarily a long tome of information. And there's just a lot of pressure on and from lenders and BDOs within lending institutions. And one of the big things that happens here is the size of the institution and how this is all addressed. So for environmental, for instance, I'm part of an organization called the Environmental Bankers Association, which is a big chunk of folks involved there are the regional and national lenders that have environmental people on staff. They've got staffs that help manage the process. They have staff members that can help screen lower risk loans and do a lot of the work internally. But the majority of the banks don't have someone like that on staff. And much like I think with Mountain Seed, we work with a lot of credit unions and community banks who have commercial real estate departments. They have commercial lending departments, but don't necessarily have an on-staff environmental expert. But they, either they've managed through it without having to do it in the past, or they just are going at it with a little less sophistication than what the larger banks are. But for the most part, a lot of times those smaller banks and credit unions are the ones who are starting to ramp up their commercial real estate programs and really should have a policy and procedure in place to make sure that they're doing their work correctly, making sure that it's compliant with what the OCC and the FDIC and SBA and everyone else is saying they should be doing, but also to make sure that it's well publicized and competitive as well. And I'll talk a little bit more about that as we go through this presentation. The big part of what they do have to do, and this is both for regional and national as well as the community banks, is to rely on external guidance to dictate what needs to get done. The one thing that's different within environmental versus appraisal is that there aren't specific, other than for SBA, which I'll talk about, there's really not a specific level of due diligence that needs to be done for various properties within a bank or within a credit union. It's really up to the credit union or the bank to make that decision on their own and to determine what their individual risk policy is within their own institution. And that can create some confusion. I think I've said in the past, and I'll talk about this in a second, but if someone, I think from the FDIC or OCC or NCUA or, would do something like the SBA did, which is come back and say, at this certain level, you need to do one type of environmental report, and at this level, you need to do a different kind of environmental report. I think it would make the whole topic and the whole issue much better, because you wouldn't have lenders competing based on levels of due diligence versus they can compete on rate and relationships and everything else they typically would do. So we'll talk a little bit about that as we go through this as well. But the big component here is that the larger banks typically have someone on staff to manage this. The smaller ones don't. And we do see a lot of folks looking for help in that situation, and that's what we're trying to talk about here today as well. The other thing that's really important to differentiate, excuse me, is policy versus procedure. And for you bankers out there, policies can be long and boring and a lot of words to explain something that may not be as seem like is necessary. But basically, the policy part of the situation is it's a formal document. It needs to follow regulations. It needs to follow in with the rest of the policy within a bank or credit union, and it's really meant to balance risk for a lender. But what we found, and when I was at Fleet Bank, back a ways back, the policy was what was in place to meet the requirements of the bank and to make sure that if an auditor came out and looked at it, that everything was written down in place. But it really didn't explain the boots on the ground, how things got done. And that's where the procedure really comes into place. So the procedures are, how do I comply with this policy? So a policy may be a very broad statement that says the bank needs to follow a due diligence policy that it has, but not get into very specific issues. The procedure is really how the policy gets executed, and it really is, like I said, where the rubber meets the road as far as the policy goes. It should be simple, easy to follow, and really well publicized within the bank or the institution. I think really what matters, and this is kind of a general theme on the environmental side, is the more people within the organization that understand what needs to be done and it's communicated to, and then therefore can communicate it to clients and folks that need to know it on the outside, it usually makes it better. But usually the key component of one of these procedures is a risk matrix of some sort, which defines property types and property value or loan value. Often it's in a matrix. Everyone can tweak it a little bit. Not everyone's going to have the same matrix, but I think the general matrix term is something that's very easy to deal with, very easy to understand. And from our experience, when someone on the lending side has access to this matrix, they are armed with the information that they need to know to explain to their client that, okay, we're going to have a loan that's $1.5 million. Per our policy, you need to do a phase one or something like that. And we'll talk a little bit more about that as we go through this. It really is a roadmap for the lender to adhere to the policy as well. So it's a way to really simply figure out what needs to get done. But I think the biggest concern or the biggest opportunity and challenge with any kind of environmental policy or procedure is that it needs to be communicated clearly to everyone in the organization to make sure that the day-to-day operations run smoothly. And that's a big key component to environmental in general, is the more you can communicate, whether it be internally or externally, about what's getting done, the easier the process can be. And I think that's one of the pieces that gets missed a lot of times within the process, is not communicating it to a borrower or a seller or a lender, what needs to get done. Because usually if it can be communicated correctly and clearly, a lot of times people will understand. It's not foolproof, but it is a way to make it a little easier. So some of the things that happened within the industry to kind of create this whole policy thought process, and I'm not going to go into much detail with these, but the FDIC clearly is one of the major regulators. And over the last several years, the FDIC and the OCC have sort of combined forces when it comes to putting out memos and things like that about environmental and appraisal with the interagency guidelines. But within the FDIC, you've got, they emphasize process and consistency. They emphasize training, policies and procedures should be established. They really made a big focus on risk analysis. And I think that's something, you'll hear throughout this discussion, It's one thing to get information about the environmental issues. It's another thing to have someone review it that understands what it all means. And sometimes it can be an internal person, but a lot of times it's easier to have someone who's more familiar with these issues, who you may not have on staff, manage that process. Documentation of the due diligence is important. Tracking of changes, so exceptions or waivers need to be done. You need to monitor the policy to make sure that it still is up to speed. If regulations change, you should update that and things like that. And then one of the big issues with lenders is on a foreclosure perspective, or even if you're managing a loan, is you don't want to participate in the management of the business. Because if you start to dictate how things get done at the property and an environmental issue occurs, you could get yourself in trouble with CERCLA, which is the federal statute regarding hazardous waste management and things like that. So you want to make sure that if you're foreclosing on a property, you're not managing the property, so that you're not in the chain of title or the chain of command in any way. And then for foreclosures, typically the FDIC says, phase ones are usually what needs to get done. The other side of this is the OCC, who also updated their policy. And the OCC has basically developed policies. What they recommended or advised is to develop policies and procedures that reflect potential environmental risks associated with the lending. They also had to specify, which seems kind of obvious, but they wanted to specify that you should make sure you get the environmental information taken care of before your final commitment. Try not to commit to anything without understanding what you're getting into. And then making sure that there's people responsible for environmental reviews do have the relevant skills, knowledge, and competence to do that work. And the policy should include the AAI rule, which it's the phase one rule. I'm not going to get into it here. I think that's been discussed in the past. But the AAI rule is basically the federal EPA's standard for a phase one and how to keep your CERCLA protection within that. The third, it's not a federal agency. Well, it is a federal agency, but it's not a regulator. Is the SBA, and I'll just make this point here. I think the SBA, from an environmental perspective, has done a wonderful job defining what needs to get done very simply and very specifically. And for whatever reason, the OCC and the FDIC have chosen not to do this. But the SBA has basically said if you have a property that has a high risk, either current use or former use at the property, then a phase one needs to be done. And if you're not familiar with what a phase one is, it's basically the general environmental report that gets done. I would equate it to what an appraisal is to the evaluation side. A phase one is the standard of care for an environmental study, non-invasive. You're not taking samples or anything. It's purely a site visit and a lot of research about the property. But that's what the SBA requires for a property that is considered to be high risk or elevated risk, or sensitive environmental industry type of an environmental sensitive condition of a property. If it doesn't meet that need or meet that requirement, the SBA has basically said you can do what they call a record search with risk assessment, which is, I'll talk about this in a few minutes, but it's a desktop review for lower risk properties. And basically what that entails is it entails pulling most of the data that you might get in a phase one from a desktop, ordering it through a data company or doing research on your own or a combination of both, including historical records, which would include fire insurance maps or city directories or aerial photographs or other types of historical uses, and then coming up with an opinion, basically a high or low or elevated risk, to state whether or not there's any concerns there. And the SBA has defined, in their minds, they said if it's a low-risk property, we think that's a good starting point. And if it comes back with a low risk and it's reasonably done, then you can move on and do the work. The point I try to make with this is whether or not you love the levels of due diligence at whatever property there is, it just defines what needs to be done. So if SBA lender A is going at a property or looking at a property that SBA B is looking at, there shouldn't be a concern about what level of due diligence is being done because it's defined right in the policy in the standard operating procedures for the SBA. And it just makes it much easier. So I'm a big fan of what the SBA has done. I think in the environmental world, it's very similar to, I'm obviously there's been a lot of attention about the evaluation level going from $250,000 to $500,000 over the last several weeks. And it's very similar in that respect, in that it's defined, people know what they can and can't do, and it makes it easier to just move forward with a clear understanding of what needs to be done. So a couple of things that happened most recently with the SBA, and I'm just going to go through this really quickly because I think there's some good information there, is that the phase one reports are now good for a year. So if you do an SBA deal and you have a report that's been done within the last year, it can typically be used for an SBA loan. The RSRA needs to include the data that's been relied upon, so you have to include as appendices any data that was used. Dry cleaners, and this is just a general term, I mean, dry cleaners require a phase one and a phase two for any dry cleaner that goes through the SBA process. And to be honest with you, if it's been a dry cleaner there for a long time, we would usually recommend to our clients that a phase two is probably going to be required anyway. So the SBA is just trying to kind of go down the path that most people have already gone down. There's a reliance letter that's required within the SBA. The client or the environmental professional must have errors and omissions or professional liability insurance up to $1 million, at least $1 million, I should say. And then there's the way that they define what a high risk and a low risk property is through the NAICS codes, which used to be the SIC codes, which basically defines the type of industry that's at the property. So this is just a sample matrix. I was talking about the matrix that you want to put in. This is specifically for SBA. So you can see here that low risk loans would require a certain level. So under $150,000, you can actually do a questionnaire only for a low risk loan. Above 150 and less than 5 million for a low risk loan, you can do that RSRA. And for high risk loans, you need to do a phase one, no matter how much the loan value is. And then I talk a little bit more in the next couple slides about these other types of loans. So you're looking at all these different types of loan, these due diligence options, and it can really run the gamut here as far as what you can do. And I explained how it's similar to the appraisal side. It used to be you either did an environmental questionnaire or you might do a phase one and potentially do like a transaction screen. But other than that, there really weren't a lot of options. And over the last several years, probably the last 10 or 15, in fact, even when I was at Fleet Bank in the early 2000s, we started to add different levels of due diligence based on risk level and loan amounts. So some of the things we started to see are these screening products, whether it be a database screen, a desktop due diligence, which is basically that RSRA that I just talked about within the SBA. A desktop review has become an interim step of environmental, and I would equate the evaluation to a appraisal is what a desktop review is to a phase one, meaning a desktop review is definitely not a phase one. It doesn't give you as much information. You don't have boots on the ground looking at the property, but you get a lot of information about what is there and what was there, and it also tells you whether or not there's been issues that the state or the federal government may be aware of from a spill or from an old property. It also gives you information about what former uses were there. So you could find out, in 1965, there was a gas station where there's now a bank branch and things like that. You get a lot of that information through the desktop due diligence process. And then you go down, and unfortunately people don't like to hear this, but then you have phase twos and phase threes. You've got things like stormwater issues. Environmental insurance is still out there. Some people like it, some people don't. There's escrow agreements that can be done. So there's all these different due diligence options, and I'm going to tie back into this again in a bit. But really, there's a lot of ways to skin the cat when it comes to environmental, and it's really understanding what the risks are and how they fit in. So for gas stations, I'm not going to get into this very detailed here. It's here, but basically, this is the SBA requirements that requires a phase one for any gas station. And also, you have to make sure the environmental professional needs to make sure that the regulatory issues are all complied with as well. So you could do a phase one and say that it looks clean, but the environmental professional also has to opine and document that the gas station is in compliance with the state or local or federal or whatever laws that it has to comply with or regulations. This is a good sort of a standard practice, even if you're just doing gas station loans on your own balance sheets. It's always important to know that they're up to speed with the most recent tank leak detection systems, that their tanks are intact, that they've been upgraded if they needed to be upgraded, things like that. So for dry cleaners, one of the things that I just show this because this is what came right from the SOP of the SBA is it used to allow for a 5-year grace period, and now unfortunately the phase one and I don't know if it's unfortunately, it's probably more realistic. A phase one and a phase two needs to be required for any dry cleaning facility going forward, and that was because people were just finding lots of contamination at these dry cleaners, unfortunately. And it also needs to be done by a professional engineer or a registered geologist, which is important to know for an SBA loan. And then for daycare centers, for special use properties, mostly around daycare centers, daycares, child care centers, if the property was built prior to 1980 when lead paint and lead was phased out, a lead risk assessment for paint and for water, drinking water in the building needs to be done. Once again, I mean, not to toot the SBA's horn here, but the SBA has sort of taken a very good risk approach to say, okay, these are things that could be a problem, and this is why we think you need to do them. But it's important to know if you're doing an SBA loan that you need to comply with these, even for like daycare centers. But today I just had one of our clients call about a daycare center SBA loan that they're building ground up, and they wanted to know if they need to do any lead-based testing, and the answer was no, because the building is going to be built now. The assumption is that there's going to be no lead in the paint that gets done, and there's going to be no lead in the drinking water because the piping is different than it used to be before 1980. So those are just things to keep in mind. And then there's this issue, if you read a phase one or get some environmental information, especially over the last 4 or 5 years, and you start to see this thing called vapor intrusion, it's not a way that environmental professionals are trying to make another issue emerge. It's actually something that came out of some recent studies that explains that typically in the past, if you did a cleanup, the concern was drinking the water that might be contaminated or eating the dirt that might be contaminated. But what wasn't contemplated was air getting into the buildings that people might be in and causing health issues that way. So this is an issue that you may start to see, or hopefully you probably have seen in reports being discussed, which is called vapor intrusion, which means are people on the property being exposed to harmful vapors? And it is discussed now in phase ones more than it had been in the past. So some of the issues that you might be seeing within phase ones or in desktop reviews or any environmental studies is underground storage tanks. Are they old gas tanks, fuel oil tanks that might be there, spills, hazardous waste disposal or storage? I mentioned vapor intrusion. Mold, if there's been water problems in the building, you may have mold growth. Good thing about mold is usually you can just remove it and it's done. Gas stations, dry cleaners, lead paint and asbestos. Something we're seeing more of now is PCBs and caulking of buildings. We're seeing a lot of renovations of old buildings into housing. So there's one that I'm working on right now that's an old convent that's been there for 100 years, and part of the renovation is to become a new a new apartment building. But one of the hang-ups is PCBs and the caulking is costing a lot of money to manage, because when it gets removed, it needs to be disposed of differently than just regular caulking would be. Radon, stormwater, Superfund sites, things like that. So once again, what are the different kinds of report types that you might run into? And I used a couple of our versions, but I mean, in general, the first level of desktop review is really just a database review only. There's companies out there that provide just a straight data, very low level data review, or not a review, but just a database report, and it's up to the bank or the credit union to evaluate what it all means. We typically try to promote having someone look at the information that understands the data, regardless of what level of information you get. So if you have a full database with a review, we call it our EnviroFlash, but in general, that's just a database review with a third-party review. What we're seeing a lot of is this desktop review, which is what we were talking about earlier, the RSRA, which is data plus historical research. But once again, I think the key component to a policy or procedure is just making sure that whoever's reviewing the information understands what it all means. Another thing we see a lot of, and this is something that is written into most people's procedures, is third-party reviews of other people's reports. So this can take on a couple different methods, I guess. One of them is if a borrower comes to a bank or a credit union with a phase one in hand that they've already gotten done because they wanted to know what was there. We see a lot of times those reports having to be reviewed to make sure they're compliant with the bank's policy. And that's a big component of what we see. The other thing we see a lot of is in refi situations where the borrower may have done a phase one a couple years ago or 5 years ago, and now they're, for lack of a better term, they're shopping the project around or the loan around. And if it's a low-risk property and a phase one was done a few years back, oftentimes we're asked to review those reports to make sure that they're still okay, and assuming it's not a gas station or dry cleaner or some sort of industrial facility, trying to really bridge the gap between the two levels, between what was done then. And this becomes a competitive issue because you may not want to have to do a new phase one, or a borrower may not be willing to spend the money on a new phase one, but you still want to do the deal because it's a good deal. It's a way that a third-party review can help manage that process. The other thing we see a lot of banks starting to do is just managing the entire phase one process, or the environmental process, being outsourced for procurement and for assistance. And it's similar to on the appraisal side that's happening as well. We're seeing more and more of that happening, mainly because they don't have the staff, and most of the costs regarding that can be passed through onto the to the borrowers that they're working with. And the other thing we see is environmental reviews, appraisal reviews, policy development and evaluation, training programs. I think one of the key components of all the different the regulators, they say that there should be a training program, as well as people that are doing the work should be qualified. That's very specific. So we've seen a lot more training being done in general. And just making sure that the people that are working on the environmental process within your bank or credit union are the right people, do understand what's being done, and are the right group for the right project. And sometimes that not everyone understands what that means. So we find ourselves helping a lot of banks and credit unions doing that as well. So just a quick overview of what the various products are. You got the questionnaire. Like I mentioned earlier, a lot of people were just using the questionnaire. For the SBA, there's a requirement that the questionnaire needs to be done with the RSRA. But basically, ideally it's the seller or the owner or operator of the property completes the questionnaire stating what they know about the property, so you can get somewhat of an idea of what's there. The environmental screening report, like I mentioned, it's an evaluation. It's data plus an evaluation by someone who understands what it all means. And the key there is not only understanding it, but how does it fit into your deal? And I think that's a key component within the environmental process, is that there's really two levels of things you're trying to figure out. One of them is what are the environmental issues or potential environmental issues. And the second one's really a strategic decision is, okay, this is what I know. What do I need to do to make it work for my deal? And it could be anything from, oh my gosh, this is all sorts of contamination at this property, we don't want to touch this with a 10-foot pole, to, okay, maybe there could be a problem there. We don't know about it. We don't know it right now. We are aware that there could be a problem, but that the deal itself can work regardless. We want it to work, but we want to understand what's there, so that at least the bank or the credit union knows what they have in place, so that if they ever do have to foreclose, it's not a blind situation. So it's really a strategic, and I think the entire environmental process becomes a strategic discussion, where, okay, know what you need to know, but then also how does it fit into the overall deal. And one of the things we pride ourselves on with what we do is that we try to help bridge that gap between the data and the results of the environmental to what the bank needs and getting a loan done, because obviously unless loans get done, none of this makes sense for anyone. So that's a big component of the policy, is how do you get from point A to point B, and how does it dictate how that gets done. The desktop review, like I mentioned, it's current along with historical records and a third-party review. There's things called the transaction screen, which is like a phase one light. It's a little less than the typical transactions. It's less than what's in a phase one, but it's more than what's in a desktop review. Mainly there's a site visit. And then the phase one, like we talked about, it was updated in 2013. A couple major changes in that were the bigger ones were the vapor intrusion being added to it, as well as a couple definitions that were clarified. I'm not going to spend much time here. This is the environmental matrix. This is an example of an environmental matrix that we have worked with clients and had variations. Everything can change on this, is what I would say. Whether it be the level of due diligence, whether it be the values up top. So some people we work with want a phase one on every project. Some people want to go from 250 and below. They want to do a certain type of screen. They might go from 250 to $1 million and want something that's in the middle category, and then over that last thing, they might want to do a phase one for everything. But I just show this as a representative of what could be there. If you have any questions on this, or there's anything I can clarify or help with, we could help with this as well. Feel free to reach out, and be happy to talk more about kind of how this all works. So in general, I think really what I'm trying to get across here is really best practices. And I think the key here is what can you do on the lending side to make this process easier? And there's a variety of different things you can do. I tried to highlight them on the next couple slides, but the biggest thing I think is really having as much control of the process as possible. And I know this isn't always possible to do, but if you can manage the process, pick who's doing the reviews, pick who's doing the consulting itself. If you need to do a phase two, make sure that the company doing the phase two is a company that knows what they're doing, that is taking samples of things that need to be sampled, that isn't trying to win a project by getting a low bid and then not doing a proper job, things like that. So if you can control the process, it's always much better. The other thing is you want to just collect as much information as you can up front. So what that means is we do a lot of desktop reviews where we'll come back and say, oh, it looks like there was a tank that was there. There's no information about it. It looks like it might still be in the ground, or it was removed and we don't know how it was removed. And then out of the blue comes a report from the seller saying, oh, no, we removed that tank, 7 years ago, and here's the cleanup report, and here's everything that goes along with it. It just makes the process take longer. And the more you can collect up front and get in front of the people doing the reviews, the quicker you can get it done. Just know that gas stations and dry cleaners are going to take longer typically than a typical office or some other kind of property, just because of the nature of the business that they are. Like kind of ties into the first bullet. Try not to let the borrowers control the due diligence, especially the sellers is really more challenging because the seller typically has no interest in finding problems. They might hire a consultant that tells them what they want to hear, but isn't as upfront with or forthright with potential risks for you or for your borrower. Make sure that you understand the property uses. If you know that it was a gas station 30 years ago, don't try to do a screen. You're better off just going right to a phase one and make sure the reports are correct. One of the things that I try to promote with what we do, but also ultimately the lenders are the ones who really communicate this, is especially when someone's buying a piece of property, everything that the bank is looking to do to protect their interests typically align with a buyer of a property looking to make sure that their property is clean beforehand. And it amazes me. And it really, a lot of the work we do is on the small business side of the business, because that's typically the stuff that's less than $1 million, where you do a lot more screening reports, you do more desktop reviews and things like that. But those are also the level of loans that you have a lot of mom and pop or smaller, unsophisticated real estate buyers buying pieces of property. And they end up looking at the environmental and the appraisal a lot of times as just a fee that the bank is requiring for them to do. And I think it's really important, if possible, to turn that discussion around to say, okay, I know, the bank's requiring the fee and requiring environmental, but what we find out in this environmental report is actually more critical and more helpful for you than it is for the bank, because ideally you're not going to default in your loan, and me as the bank or credit union is not going to have to get involved in this property, but you now have this piece of property that needs, if you need to do cleanup on it at some point in the future, it's going to affect the collateral value of your property, and it's going to affect the marketability of your property. So I think the key here, and this goes back to the communication issue, is to really communicate that the environmental issues that we're trying to resolve are really in everyone's best interest. And for what we do at our company here, our company's really just trying to get to that end game to understand, okay, these are your concerns, these are your potential risks. If you want to go ahead and do something, go ahead and do it, but know what the risks are before you do it. And I think it's really a huge opportunity on the lending side to be able to be that trusted business advisor for their clients, to be able to tell them, okay, we're requiring the phase one, or we're requiring an environmental report, but it's really meant to help you as much as it is us. And it's not always easy. It's sometimes easier said than done, but that's the key. The other thing, just a couple more best practices, is create and follow environmental policies and procedures. We talked a little bit about that. The nice thing about what the environmental process does is it really is no cost to the bank or the credit union, because everything typically is passed through on to the to the borrower. So even if it is a third-party review fee, like what we would do normally, it usually is all forwarded over to the borrower. So the bank or the credit union ultimately can get environmental reviews done for free, for lack of a better term, unless it's a foreclosure, because they can pass on those costs. But once again, those costs are also valuable to the borrower as well. The questionnaire is important. Making sure you get at least some government records for each property transaction makes a lot of sense. I tried to explain a little bit, but really there's different types of properties and there's different levels of due diligence, and not every property requires the same amount of due diligence. So if you've got a low risk property that doesn't look like it's much of anything, a desktop review might be perfectly fine, but if you've got an old industrial facility, I would recommend you don't do a desktop review because most likely it's going to come back with a high risk because of potential operations there. The other thing that's really key, and it kind of ties in with everything else, is just starting the process early as possible. Environmental concerns can cause a lot of headaches, can make people go a little crazy at times with what needs to get done. But usually the reason why it's a big problem is because and I talked about this at the very beginning of the presentation, it's because it's kind of jammed in at the end, and everyone's sort of on eggshells waiting for the results to come back in. And if it comes back with any kind of further action required, usually there's a closing date or there's a meeting already set up for a closing. Everyone's all freaking out about, we only have 2 days to resolve this before the closing. And unfortunately, I probably can't change the way that gets done. Ideally, you wouldn't set a closing date until you make sure the environmental is all taken care of. But earlier, the better. The more you can communicate, the better. Most environmental issues, unless they're just god-awful, can be managed. You just need to have some time to think things through and make sure you understand what the issues are before you go forward with it. And then the last thing is just, having someone. I mentioned earlier how the larger banks have people on staff and a lot of the smaller institutions don't. If you have someone you can lean on that has experience in the area to review this information that isn't really part of the banking operation. Typically what we found is a lot of times if there's an appraisal manager, they might be doing the environmental as well. Other times I always joke with if there's a lender or a credit person who ends up being the environmental person, I always, sometimes I'm actually right about this, is that it's the person that missed the meeting to determine who is going to do the environmental reviews for the bank or the credit union. They're the ones who end up getting that job. So it's not a core competency of the bank. And much like other things that happen within the bank or credit union, environmental typically is not that core competency. So we've been seeing more and more folks looking for help on that situation or for those kind of reviews. So just a couple last slides here. I think, what we're trying to avoid and why you do the environmental, and this is a real life case. This is what something looks like today. This is a strip mall. I think it was in Texas. This is what it looks like today. And I could almost insert a bank branch in a similar situation like this because that's what it looks like today. It looks fine, looks like a low risk property. But back, 60 years ago, it was a grocery and gas station. And you wouldn't know that unless you did some sort of environmental research, whether it be, even a desktop review could give you a reverse directory telling you that this used to be a grocery, but somehow this picture came about. Honestly, this one's kind of an anomaly. I don't know how this picture came out to be found, but it was something that without doing research and without doing environmental due diligence, you never would know of. But ultimately, I think the whole process, it doesn't have to be difficult. It just needs to be clear, and people just need to understand what's being done. But at the end of the day, the entire process, it's not foolproof. I get a kick out of this one all the time. I'm not sure this helmet's going to do a whole lot of good one way or the other, but it's risk management. And really what we're trying to help with is understanding and managing risk. And the environmental is no different than any other risk that you're dealing with. There is risk. There's ways to try to mitigate the risk, but it's all but impossible to completely eliminate it. So what we're trying to do is just help our clients really understand what needs to get done. Environmental due diligence is meant to do that. And I think it's not foolproof, but if you have a good policy in place and you've got someone to help manage the process or who understands it, I think it makes it much easier to manage the issues in general. But ultimately, our job is to determine for our clients, and I think the environmental process is, how much is it going to cost and how long is it going to take? And that's really what you as lenders need to know. And ideally, it's no money and no time and everything's good to go. But if there is any issues, a big part of what we have to do is help manage the process. And the environmental process in general is, just determining what the risks are. How long is it going to take to get rid of it and how much is it going to cost? And once you know those two things definitively, you can work it into an overall project. So with that, there's a couple testimonials here from folks. I think I'm going to wrap it up here. I'm just going to give you just a quick overview of who we are as ORMS. We work with banks and credit unions throughout the country. We work with lots of SBA lenders as well. We've developed a nice little niche in the industry with helping with the SBA process. We've developed really good relationships with both lenders who are involved in the programs as well as the SBA themselves. It's like anything else that you do. Whether it's your mechanic or anyone else, someone who's doing these things over and over again tends to know the nuances and the how to get to the end game a little quicker just because of repetition. And that's something we've been able to do. We really do. We're not a phase one contract. We don't do phase ones. We don't do phase twos. Honestly, we don't really set foot on properties typically. We work as if we are an extension of our lender clients, much like the bigger banks have their on-staff people. We manage that process as if we're on staff. So we help our bank clients manage the process, select consultants, review reports, do desktop reviews, things like that. We're members very involved in the industry, part of the Environmental Bankers Association, like I mentioned, NADCO and NAGL on the SBA side. We're involved in the RMA. Lots of expertise in due diligence. Plenty. I don't like promoting it, but we're insured, and we really were founded with SBA lenders, credit unions, community and regional banks as our focus to be able to manage the process, to be able to let you all do more by outsourcing the risk management process without having to bog your own people down and let your people do more credit risks and selling and things like that. But like I said, we're really a virtual environmental risk manager. We do everything but from reviewing reports to helping people order reports from third-party vendors as well, and everything in between. And really set up to be a business advisor for you and for folks that are doing this. So with that, I think I'm going to hand it back over to Melanie or to Nathan, whoever might be on that end at this point, if there's any questions.
Great. Thanks, Derek. Well, we got a couple of comments in that it was great content. So thank you for that. Just FYI, it seems like it's
thank you.
It was definitely helpful to people. One question that did come through, I think we've got time for this one question, if you don't mind, kind of me putting you on the spot. And if you
Sure.
don't have an immediate answer, we'll just follow up with this person and get you to get them the answer. Somebody had a question about dry cleaners and the concept behind doing a phase one and a phase two at the same time on a dry cleaners, and wouldn't it make sense to just go straight to a phase two? So do you have any thoughts on that immediately, or do you want to follow up on that?
No, I'll speak to that. So it happens with dry cleaners a lot, especially with the SBA rules changing. But it happens a lot when you know there's a problem at a property. We hear that a lot, like, why don't we just go to a phase two? And the difference, the reason you don't want to do that is what you know is what you'd investigate in a phase two. But a phase one is really a comprehensive review of a property. And by doing that comprehensive review, you're probably going to bring up what you know about. So like for a dry cleaner, you may know that there was an underground tank or something like that at the property. But what you may not know is that there were other tanks 30 years ago in a different location that you wouldn't even think to study or to take a sample at because you hadn't done the research. So what we do see, so I would never recommend doing a phase two without having a phase one done for most properties. If it's just a tank or something like that, maybe that's one thing. But for a dry cleaner, you really want to make sure you do a full phase one to understand the full scope of what's there. And then you can define what needs to get done within the phase two and really define what the scope of work is. What we do see, though, at times is people know they're going to do them both. So typically a phase one might take 3 weeks, and then a phase two might take 6 to 8 weeks because you wait for the phase one results, come back, and then you define what the next step is. We have had situations where we've worked with consultants to go out and help them, define their scope, where as they're doing the phase one, they're also scoping out where the locations for the phase two are going to be. So they may be able to eliminate a couple weeks. And a lot of times timing is as big of an issue as the actual cost. So there are ways to maybe to compress the time that gets done, but I would never recommend doing a phase two on a dry cleaner without a phase one. And if it's an SBA loan, it won't get accepted because it needs to have that phase one first.
Great. One other follow-up question, Derek, and then we're going to have to break for time. Somebody asked about dry cleaners that are drop-off only, so there's no processing done on site. Do you know if there's any requirements related to those?
If you can prove that it's only been a drop-off and that it's like if it's a strip mall that it's only been a drop-off and never ever had any operations there, typically you can get an exception to the dry cleaner issue because it truly is just a drop-off and there's no operations. One thing I will call there are exceptions, and we both for the SBA as well as conventional lending. I think if it's always been a drop-off, you typically can get away from the rules there. The one thing I will it seems dry cleaners are always a big topic, but if you hear of someone saying they have a green dry cleaner, typically you hear that a lot with newer loans. They'll say, "Oh, it's a green operation." I would ask, the first question I would ask is, how long have you been doing it, and what did you do prior to? But even the green operations are still a little bit, they're not perfect. So there really hasn't been any definitive conclusion with what needs to get done if you're having a green operation or something like that. So, but dry cleaners, unfortunately, they typically have problems. And if you have a dry cleaner that's been doing it for years and years and years, there's more likely than not going to be a problem at the property, or at least some contamination at the property. So you just want to really understand what's there, or just have your eyes open when you're doing the projects.
Great. Well, Derek, this was really helpful, as evidenced by the comments. Thank you for taking the time to do this. Thank you for everybody for attending. You've got Derek's contact information there. If you have any questions, obviously you can route those to us, and we can get them to Derek, or you can contact Derek directly. Thank you, everybody, and we will see you back here next time.
Thank you very much.
Thanks, Derek.